So, you've probably seen the headlines, right? AI is supposedly taking over stock trading.
Yeah, absolutely. And these large language models, GPT, Gemini, Claude, all this, they're front and center in that conversation.
They really are. But, while they're amazing with words, trading, well, that's a different beast, isn't it? It's about heavy-duty number crunching, adapting constantly.
Exactly. And that's where LLMs, well, in their current form anyway, seem to hit a wall.
Right. So today we want to dive into why just using these language AI models for serious quantitative stock analysis maybe isn't the whole story.
And we'll look at another approach, something called Symbiotic Quant Intelligence, or SQI.
Yeah, SQI.
Yeah.
We've looked at some really interesting articles that break down the limits and maybe the more effective paths forward.
And the initial buzz around LLMs in finance, it makes sense. They are incredible at understanding language.
Oh, definitely.
Think about summarizing dense financial reports or gauging sentiment from news articles, even understanding market chatter. That's powerful stuff.
Totally. They can sift through mountains of text super fast, pull out the key ideas, reading an earnings call transcript in seconds, or getting the market mood from Twitter.
That speed, that kind of broad analysis, it's definitely useful.
It is. But okay, let's unpack this a bit, because the sources we've seen are pretty clear that when you get down to the nitty-gritty, the quantitative side, the actual trading, these models start to show some, significant weaknesses.
That really is the core issue, isn't it? LLMs are just fundamentally built for language tasks. Their whole architecture is optimized for that.
Not for the kind of, complex math and dynamic market analysis that trading demands.
It's a bit like asking a brilliant translator to suddenly perform complex calculus.
Yeah, or like you said before, a master chef doing brain surgery. Skilled, but completely different tools and training needed.
Exactly. So let's get specific. One big limitation highlighted is just that they're designed for language, not deep quantitative work. Their strength is processing words, generating text that sounds right, that fits the context. They can describe financial concepts found in text really well.
Okay.
But they don't inherently have the machinery to, say, dynamically diagnose complex price patterns or execute trades with strict algorithmic rules.
So they can tell you what a mass CD is, but maybe not use it effectively in a fast-paced trading algorithm.
Precisely. That kind of real-time application and algorithmic rigor,
yeah,
that's a different skill set.
And when you say algorithmic rigor, you mean those really precise step-by-step instructions a trading program needs, no wiggle room for interpretation.
Exactly that. Unambiguous logic driving the decisions.
Okay. And building on that, another big challenge mentioned is how they handle real-time market adaptation. The sources say they're mostly trained on, static historical data.
And that's a major hurdle. Markets don't stand still, do they? They're constantly shifting, reacting to news, changing dynamics. LLMs, because they rely on that past data, they kind of struggle to continuously absorb and process the flood of real-time information needed to adjust strategies on the fly.
So they can't really keep up in the way a dedicated quant model built for that purpose can.
Not in the same way, no.
Yeah.
Specialized trading algorithms are designed specifically for that continuous data ingestion and adaptation.
And it's not just the speed or volume of data, it's the complexity too, right? Like dealing with conflicting signals from different indicators.
Oh, absolutely. An LLM can explain what Bollinger Bands are, or RSI. But real trading often involves getting mixed signals. Maybe one says buy, another says hold or even sell. An effective system needs to weigh these, prioritize them, make a nuanced call based on complex, sometimes contradictory inputs.
Yeah.
That level of algorithmic sophistication, it's generally beyond what a standalone LLM offers.
It's like they know the individual instruments but can't quite conduct the whole orchestra in real time.
That's a good way to put it. And it extends to the heavy math needed for prediction, too.
Right, things like time series forecasting, predicting future prices based on past patterns.
Exactly. Or risk-adjusted optimization, other really computationally heavy stuff. LLMs can do basic math, sure, but they aren't optimized for these advanced machine learning techniques that drive predictive trading. Their core strength is language.
Which leads to, I think, a really critical point from the articles, the potential for just getting things wrong, misinterpretation.
Yes. Because they work by predicting the most probable next word or phrase, they can generate answers that sound really plausible, really confident, but are actually incorrect financially.
And in finance, precision is everything. Small mistakes can be costly.
Extremely costly. So relying solely on an LLM, which is essentially making probabilistic language guesses,
Yeah.
for critical trading decisions carries inherent risk. It's not necessarily finding the most accurate financial outcome based on the numbers.
Okay, so it's clear LLMs have some real hurdles for deep quantitative trading. That brings us to this idea of Symbiotic Quant Intelligence, SQI. What exactly is that? How does it try to fix these issues?
Well, think of SQI as aiming for balance. It's about intelligently merging those traditional algorithmic models, the ones good at math and real-time data, with the insights and understanding that humans bring, human domain expertise.
So not replacing humans, but working with them.
Precisely. It's about creating a partnership.
Yeah.
You use the machine's strengths, speed, data processing, lack of emotion to complement the human strengths, intuition, understanding context, adapting to truly novel situations. It strengthens both.
Okay, that makes sense. So combining the best of both. The sources we read pointed out some key benefits. One was augmenting expertise.
Yeah, XQI uses that quantitative power, the algorithms and machine learning, to sharpen decision-making. But critically, it values human intuition, especially when markets get weird or complex, unstructured conditions.
Unlike a purely automated system that might just follow rules blindly.
Right, a purely automated system might miss subtle clues or context that a human expert picks up on. SQI lets the human guide and refine what the algorithms are doing.
Interesting. Another benefit mentioned was transparency, which is huge, right? People get nervous about black box AI.
Transparency is absolutely crucial for trust, especially with investments. SQI systems often try to use explainable AI methods.
Meaning you can actually see why the system is suggesting a certain trade?
Exactly. You get clarity on the signal generation. That's a big difference from some LLMs where figuring out the why behind an output can be really difficult, almost impossible sometimes. It gives investors more confidence when they understand the logic and the risks involved.
Makes sense. And ultimately, it's about performance, right? Better returns, manage risk. How does SQI help there?
Well, the goal of SQI is often to find what they call uncorrelated alpha, basically. Ways to make money that aren't just tied to the overall market going up or down.
Unique opportunities.
Unique drivers of return, yeah. And it uses machine learning to constantly adapt and refine its strategies as the market shifts, aiming to maximize those returns while keeping risk in check. And importantly, it does this without the emotional baggage humans have.
Ah, yes, the emotional biases, fear, greed, all that stuff that trips up human traders.
Definitely. SQI helps cut through that. It reduces things like, freezing up and not making a decision, or panic selling, or getting overly excited during a rally.
So it enforces discipline through data-driven algorithmic trades.
Allowing investors to kind of stick to the plan and avoid those gut reactions that often hurt performance.
Okay, so SQI sounds like a much more tailored and robust approach for the actual trading part. But the sources were also clear. LLMs aren't useless in finance now. It's not like it's SQI or LLMs.
No, not at all. LLMs are still incredibly valuable tools, just maybe in a different role. More supplementary.
Like for what, specifically?
They're NAV for understanding news, pulling out key stories, monitoring sentiment shifts. That's still really powerful. They can give you that broad context, the narrative around the market.
So fantastic for research, for keeping tabs on the overall story, the mood.
Exactly. They help investors stay informed, understand what people are thinking and saying. But, and this is a crucial bit, they aren't a replacement for specialized AI, like SQI uses, when it comes down to the hardcore quantitative execution of trades.
Got it. So the smartest approach, it seems, is using both strategically. A partnership.
That looks like the most effective path forward, yes. The best systems will likely blend these technologies. Use LLMs for their language strengths, research, sentiment, news analysis.
And use SQI for the structured, adaptive, risk-controlled, quantitative trading.
Precisely. Leveraging each for what it does best.
Okay, so let's try and wrap this up. The big picture seems to be large language models, super exciting for finance, great for text analysis, understanding sentiment, summarizing info. But their core design isn't really built for the intense number crunching, the real-time adaptation, the complex quantitative analysis needed for deep stock trading strategies on their own.
Right. They have inherent limitations there.
Which is why approaches like Symbiotic Quant Intelligence, SQI, look more promising for that side of things. They integrate specialized algorithms built for numbers with human expertise,
creating something potentially more robust, more adaptive, and better at managing risk for actual trading. You need AI that's specifically optimized for numerical data, real-time processing, and handling complex indicators.
It really leaves you wondering, though, As AI keeps evolving at this incredible pace, how is this synergy, this interplay between language AI and quantitative AI, going to reshape finance next?
That's the big question, isn't it? What new hybrid models might emerge? How do we best balance that raw algorithmic power with, irreplaceable human insight in markets that just keep getting more complex?
Definitely something for all of us to keep thinking about.